All right, today was a holiday, very light trading and a very important holiday. So we do like to wish a happy Veterans Day, remembering those who we've lost, those who in our families have served that might not be here anymore either, and also a shout out to those in our community, in our Market Scholars community that we know our veterans are still currently serving. So thank you all. Our appreciation goes out to you for your service and your sacrifice on a day like today where we remember that. Very important to us. From a market standpoint, probably should be a market holiday, but generally ends up being one, considering the light moves we had today. Kind of continuation of what we saw for that matter, the last couple weeks. So I'm going to break that down from a technical standpoint and what we expect this week. And then our trade idea of the day is a sector that kind of bounced back on a stock that we've traded in the past that looking for a bounce back opportunity in that stock. So let's go ahead and get started. Today is Monday, November the 11th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. So you notice, like the day before, Friday last week, we started off down, but then rallied and filled in the gaps and finished on the day to the upside. And small, very, very small gaps. So you notice the pullback that still hasn't even brought the near-term line below 50. This is 23 days now, the near-term line being above 50. But that pullback here still hasn't even gotten to the 23% Fibonacci retracement level of this 23-day near-term run that essentially started on this low point. Obviously, the run didn't start until the near-term line crossed above 50, but it came off of that low. And as of right now, that 3100 level is the high on an intraday basis, roughly. So the posture is still strongly bullish. The market sentiment's rising well above 50. Dark green shading, dark green line. So, again, you can't be more bullish. In the short term, we obviously can't be, you can be more overbought because you can never be too overbought. You just need a catalyst to spark that overbought condition to correct itself, which will happen at some point. And the problem is the more you go, the more you inhale, the harder it is, the more uncomfortable the exhale will be. And that's a little bit of the issue we have going on. So pull back to 3050, I hope would not be too uncomfortable for people. You never know these days. But that shouldn't be too uncomfortable for people. Coming back down to these old highs to 3020, that might be a little bit more uncomfortable. At 60 points, that'd be a couple percentage points off of these highs. You might get people starting to talk about recession again. Hopefully not, but you never know. But that would still just be a 38% retracement of a near-term run. And now, granted, it's also the intermediate run because this near-term rally still is the only near-term rally on this current intermediate run that we're on. Remember, intermediate runs consists of multiple near-term rallies and last 1 to 3 months. So you can see we got that same pattern going across all over the board, except for the Russell has pulled its near-term line down below 50. So that's why I think it should be happening on the S&P eventually, because it's happened on the Nasdaq. You can see here this little pullback we had. It's setting up for a little bit of a bearish divergence on the near-term line, and then you can see the Dow Jones Industrial Average. It pulled back during this stretch more than the S&P did, and that. Again, mostly due to Boeing, I believe, but it brought the near-term line down below 50. So it has happened on all the other indexes. There's the S&P. This is where the Nasdaq pulled back, and this is the current pullback that the Russell is in. So all of these have produced pullbacks on the near-term line on other major indexes, just not yet on the S&P 500. It's a broader index, at least compared to, say, the Dow Jones Industrial Average, which is price weighted, which is why the WAN stock had such an impact on it during this little stretch there. So the posture is still bullish. So any pullback we get, it's not going to change that. But it does kind of limit in terms of how bullish am I going to be today going forward. It's one thing to be, and we have been in our classes and market outlook trade ideas. We've been pretty directionally bullish during this little stretch. And we've had a lot of good opportunities that have played out over the last few weeks. But unfortunately, I can't go back now and place trades today that I would have done a few weeks ago. We have to place trades today that we expect 3 weeks from now to play out. Am I going to get another 23-day stretch run of the near-term line crossing above 50 at some point and making a 6%, 7% rally in that amount of time? The likely scenario is not. So what are the next near-term runs going to be like? Well, considering this one's been so long, I wouldn't expect them to be very long. I expect not that we'll chop all the way down to 3,000, but that we'll chop to 3050 and we'll go up and down a lot shorter, a lot quicker and more frequent than what we've seen over this past few weeks. Still maintaining, despite the choppiness in the near term, still maintaining a strong bullish intermediate posture that I expect that will continue to last into the end of the year. Okay, before we look at some other charts, as always, I invite you to subscribe to our YouTube channel. Mouse over our logo right here on the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when these videos are posted. Hit the thumbs up icon down below the video too. That tells me two things. Number one, you liked the video. Number two, you want us to do it again tomorrow. So it's our survey, it's the feedback we get. If you like us doing these videos, you want us to do it again tomorrow, let us know with one click right now. Just hit that thumbs up icon down there. Also, while you're down there throughout the video, if anything stands out to you, let us know what it is. What did you get out of the video today? That will let other people coming for the first time know why they should be checking out the video. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. That link will take you to our free subscription page. You get access to our Market Outlook forum. You also get access to our market commentary portion of our blog. It's free, it's easy. Just click that link to subscribe. Follow me on Twitter for more content in between these videos from day to day. And join our Market Outlook Facebook group that we've created for those that watch these videos day in and day out. All right, if you're watching our video on our blog here, remember again, I always point this out, our Market Outlook Live trade review videos. This is where I put on today's trade idea already. So I've already done this before the market closed today. We did it during this live video. We also track all the other trades that we've done all the way to the time that we close them. So if that's interesting to you, that's where you can check that out. We also have our upcoming classes on our schedule here. Our plus subscribers right above the video, you get access to those live trade review videos as well as all 8 of our trading rooms that we have every week. So this link above the video will give you more information on that. We also invite you to engage with us on social media. You can hit this. We got above 100 likes. That's great. The more you like the tweets and the Facebook posts, the more you will ensure that Twitter and Facebook will promote our content in your timelines, so that when so you don't miss any of our content while you're not looking. When you pull these back up, they'll make sure that they show you content that you normally engage with. So we try to make it very easy for you. Just hit this little heart, opens up that window, hit like, and then hit this image that takes you to your Facebook account and like the Facebook post from there. All right, now let's take a look at the weekly chart for the S&P 500, and you can see not as bullish, right? Because we're not closing above 30.97. That's the high of last week's candle. Doesn't mean that we have to. We don't, to maintain the trend. We don't have to. You notice there's lots of weeks where we'll close. We'll get a good strong reversal, and then we'll kind of slow down a little bit, and then we'll kind of break out. Well, don't be surprised if we don't slow down a little bit here this week, maybe even next week, before we finally close above that high point and we re-engage the trend again. That the 1 to 3 month expected trend on the intermediate line translates to 4 to 13 weeks here on excuse me, on this chart. So we're just now in the week. This is week 5. We're 1 day into week 5. So there's opportunity here. You can also see too, we've got room for this to run. We're the bullish PPO, which is a measure of this gap between the 50 and 200 day moving average. It's pretty big, but this is levels where we can be this wide for a while, as you can see back in 2017, coming off of that significant period of consolidation, similar to what we've got now, this period that we've got now, especially on a global level. If we take a look at the 3 green arrow chart for the S&P 500, we got 3 green arrows. We don't even have 1 red arrow. We are getting close on the MACD. So the histogram has definitely been pulling back, and we are flirting with the 8-day moving average. If you look at the more traditional 1226 day, you can see we're still easily above the 12-day. So we are getting some loss of momentum because the MACD is really, really high. But, a loss of momentum doesn't mean reversal yet. There's stages of reversal, and the first stage is crossing this fast-moving average, which we're not even close to on the 12-day moving average, and still kind of flirting with this 8-day. The next stage, after breaking the 8-day, is to test the 17-day multiple times, generally during an intermediate run, before we start to converge, before the 8 and 17 converge towards the 30. With a slow decline on the MACD. That's why, again, it can last, 1 to 3 months. And that 3-month intermediate runs doesn't keep the MACD up this high. It just slowly converges towards the 30 as we move up higher at a slower pace than what the 30-day moves up. And so it catches up to it. And then that's when you get your reversal to the downside, similar to this right here, but on a longer scale, obviously, because that was only a 1.5 month long intermediate run. All right, now let's take a look at the intraday chart. There's that little gap I was telling you about, similar to what we saw to a small degree on Friday. We filled in the gap there. You can see we're kind of building a volume node up here. I mentioned this gap, this stretch, this rubber band of about roughly 15 points, which is about 5%. That's going to move up tomorrow to this low point here, which will be close to that one. after tomorrow, especially, that one will be there until the end of the week. Then we start to move up, and then we'll start to move up pretty rapidly. So if we were to continue to slow and chop, our near term, this 4-week range is really going to tighten up. Which will allow for more upside room before the rubber band stretches again. So that's how this works, right? You get a good move like we've had off a low point. Now we slow down as we let this low point start to catch up a little bit. And then we start to push up higher again. And I think right now we're kind of in the slowdown mode. Not that we have to come down. We might not come all the way down to 303, and definitely probably not down to 300. So we don't have to come down. We just have to slow down, and that will allow this to start to move up. And then will allow, like I said, a tighter range that we can push up against the top and not feel so stretched like we currently are. Obviously, today's range, being a holiday, today's range and volume were really, really light. If you look at the 3 green arrows, we had 36 million shares trading hands today, way below the average at 60 million. The range was 1.25 points, half the average of almost half the 2.5 point average. So when you put those numbers in context, next one down, 4G. When you put those numbers in context, we're way below the ATR. The ATR is entrenched here. The volume is way, way low. So we're not getting any significant pullbacks anytime soon with the market pretty much as complacent as it is. the last look at this complacency is the VIX. Now the VIX did jump up from these really extreme low levels on Friday. We did bump up a little bit up to 12, a little bit under 13, but that's still in the lower end of this bullish territory. Like I said, any near-term choppiness, I've said before, at the most I think we peak up here to 15, and that will allow the monthly range, which is what I'm keeping a really, really close eye on. The monthly range right now, which again, the average range for the VIX on a monthly chart here, if I go all the way to a month, is over 8 points. So right now the range is only 1.5 points. We're not going to get anywhere close to 8.5 points this month, most likely. But we're also, even to get to half, even to get to a 4-point range, we're not going to drop, most likely not going to drop down to 8 or 9 either, which means that any kind of move, just to get a half of that average, will be a bounce up towards 15. So look for that choppiness to occur here sometime in November for us to be able to get the next high point in volatility that will allow another leg higher on where we can get good 7 to 12 day near-term runs again and continue this intermediate trend, like I said before, through to the end of the year. So to summarize, we maintain a strong bullish posture, and we're overextended in the near term and continue to be, and can be, obviously, as we have been for the past couple of weeks. And we're looking for more near-term weakness in the future, whether that's tomorrow and through pretty much mostly through the end of this week. But that doesn't mean that we can't continue to grind our way higher this week like we did last week and the week before. That's how overbought conditions work. But just remember, the longer an overbought condition lasts, longer than normal, excuse me, sorry, then the more uncomfortable the exhale is. So we should expect to get some form of exhale over the next week or two as we get some near-term choppiness, and then we rally and continue this strong bullish posture that we're on right now. So what do you think? Do you agree with that assessment or disagree? As always, there's a link popping out right there on the top right corner of your screen. Click that link. It opens up a poll. Then you can hit either agree or disagree. If you click disagree, comment down below on what you're seeing that would suggest otherwise from what we just came up with here based on our technical routine. All right, now let's transition to what's driving this price action. Look at this 3-month chart. These international stocks doing very, very well, as well as these other risk asset classes, including crude oil here more recently. And look at the pullback in safe havens. And, the 6-month chart suggests there's more pullback left to come in those areas that were so extremely bought over the long term. If you recall, from a linear regression standpoint, gold on a 5-year chart was way up here, and obviously has since been pulling back and continues to pull back, and I expect that will continue. And you can see a similar pattern on bonds as we were so far up and they've been pulling back towards, in this case, 38% retracement. But you can see the type of moves that they're having and the expectations that those kind of moves will continue. If you take a look at the 10-year note, it's a bullish candle pattern that we're getting here this week, trading up at 1.94% on the actual basis here. That's well above the 50-day moving average. You have to about 2.05% to start to fill in the rest of that gap between the 50 and the 200, which is pretty typical when you have this strong a momentum one way or the other, and you break the 50, you start to work your way inside that gap there. And then there'll be some resistance in this area right around a little bit above 2%. So look for about another probably 10 basis points to occur for yields to continue to work their way higher. This is what TLT looks like on the bearish chart as it's continuing to push its way down and fill in the gap towards its 200-day moving average, trading now at 135, and that 200-day moving average trading right about a little under 134. And you can see how strong the positive PPO was. If you take a look at the dollar index has been so volatile here lately. But you can see, it had such a great week last week, now pulling back. And so, we got a bullish intermediate confirmation signal with the rising intermediate line that still hasn't crossed above its market sentiment yet. Momentum pulling back into oversold territory just briefly. So don't be surprised if we don't get a little bit of a pop on the dollar and continue this trend. And if the intermediate line gets back above the market sentiment, above 50, then we're back to a new bullish dollar trend developing. From a trend standpoint, if you look at its Ichimoku cloud, we had pulled way back below its cloud. We're trading now up above its blue line here, this line where my cursor is, but still below the cloud. So a little bit of resistance in this area, and this is what the weekly chart looks like. So the weekly chart still holding its, still trading up above its cloud, and still trading right around this important 98 level that it kind of needs to get up and stay up above to clear this Fibonacci retracement zone that we were trading inside of for so long, that it appeared that we had broken out of before pulling back down and now bouncing back up last week. So brief little pause today. We'll see if that continues. If yields continue higher, dollars shall continue higher too. And that will put a little bit of pressure, not necessarily make them go down, but it will put a little bit of pressure on these international indexes. Not the secondary, sorry. Let's take a look at these are the next 12 biggest economies out there. Here's the 12 largest economies. Again, this is how bullish this is from a broad risk standpoint, to have all these different developed markets and emerging markets, and big emerging markets and little. And I mentioned Friday this little bullish pattern we got on Brazil, and you see how it's bounced up today off of that pattern. So very, very broad-based gains here across the board. Definitely can lead to some bullishness going forward. And as long as the odds of a rate cut stay down, you can see the market's not expecting a rate cut at all this year. By the end of the year, 3% is very, very minimal. No rate hike odds either. But now you go out to April of next year, and you can see the odds of a rate cut are only about 30% all the way out to April. That's really low. It's taken a big drop down from where it was, like even say a month ago. So very, very low odds that we're going to keep cutting. And now you go out to the end of December 20, and you can see that we're about a 60% chance of a cut by December. And that's it. That's not very much. Now, also, we're not getting any odds of a rate hike. So keep that in mind. There's still a little bit of a dovish tilt, but not enough of one that we can reasonably expect another cut anytime soon. The market's just pricing in one because it's a long time. So there's not surprising you get some odds that we get something by December 20th, but just one by the end of the year, and it's not even super high odds of that, shows that the market's just saying they're pretty much done. But we're also not looking at any kind of rate hike odds anytime soon, which is the best of both worlds, right? The yields can rise in this environment where there's no odds of rate cuts, and get that yield curve back to normal. But as long as the rate hike odds don't rise, then that will allow risk appetite to flourish without feeling like the Fed's going to pressure that risk appetite trade. One area in the market that was kind of been hit hard a little bit by, well, here, let's first take a look at the sector, and then we'll take a look at our trade idea of the day. If you take a look at the sectors and how they performed here today, it was pretty much back to the things that had pulled back. Now utilities continue to pull down, but real estate rallied, and we're going to talk about that here a little bit more in a minute. You can see, look at these financials, industrials, technology, these cyclical areas bouncing up, coming off of these really low levels in these safe haven areas, really pulling back. You can see how much they're down here. Staples to a lesser degree in pink, along with consumer discretionary as well. Everything else pretty flat on the day. If I just take a look at just today alone and how the markets performed, go to a 10-minute chart here. You can see that real estate stayed strong. Industrials and technology have been winners, and utility has been a loser. Energy has been a sector that's been kind of a weak area. That there's going to be some value opportunity there. It's just hard to get going. For example, you take a look at a stock like Halliburton, a significant player in that sector, and see how this is hard to get going. Schlumberger, another big name in that sector. You see how beaten up they are. They are in bear markets, and so until they can really get going to the upside, for that matter, clear the 200-day moving average and get any kind of golden cross going, it's going to be hard. Now, at least they do have some decreasing momentum. That this it's a big number, -10%, and that's starting to shrink rapidly. So relatively fine. There's going to be value in the energy area, but we don't want to touch that yet with a 10-foot pole until we see some improvement. But one area that did show a little bit of improvement is that real estate area. Rising rates have put some pressure on stocks like these home builders. THI, one of them. This is one of the stocks that we have in our class trading account, and it's been pulling back. But it bounced up today. If you take a look at this, the markets here, you can see a nice little bounce up there, and you can see in the ETF bounce up coming off of the low point. So we've had a little bit of a pullback, and there's some opportunity for things to look really good. And from a seasonal standpoint, a stock like Home Depot, which has pulled back and given us this little light pink shading, yellow line pattern, and a little bit of a dip here today with a gap to the downside, we might have the opportunity either to bounce off of this 3 red arrow style and get going again to the upside, fueled by earnings coming up next week, or break down and fill back in towards a 200-day moving average, because it's kind of holding the 50-day moving average. You can see on a long-term level here. Whoops, different line. Let's take a look at this one. You can see that it's well up above here and holding the 50-day moving average support. Strong momentum. So we'll either bounce off of this and continue higher, or break down into this. You see from a 3 green arrow standpoint, we had pulled back and lost a little bit of momentum. The orange line hasn't dropped below 0. The blue line can. It can drop below 0 and turn around without the orange line, similar to this. And so similar pattern may develop off of this low point that we saw over here. If you take a look at the weekly chart, you can see we're still very strong momentum. The MACD is pulled below its moving average, but both are still high, and we're still easily above the 17-week, which is where this is that last time I showed you, where basically we flirted with the 8-week, and now we may flirt with the 17-week before continuing the trend on what is a pretty strong trend. Not on the daily chart. If you look on the daily chart here, we're down to noise levels, though we are above the Ichimoku cloud, below the blue line, above the cloud, similar to the pink shading yellow line by the dip signal that we saw on the market forecast indicator. But you look at the weekly chart, and we got a strong bullish trend, and we're well up above the Ichimoku cloud, and we're trading above the green line. So very strong bullish pattern and trend developed still on the long-term basis despite the short-term weakness. So we either bounce great, or we pull back into that gap. So today's trade opportunity, today's trade opportunity is say, okay, let's take advantage of a move to the upside. We'll sell that 245 strike by the 240, both pretty deep out of the money, but within 1 standard deviation of December expiration, including the increased volatility of the earnings announcement, any kind of bounce you might get out of that. And you can see here, we are position size because of the earnings and because of that potential that we could either bounce up or gap or fill in the gap to the downside. Well, if we start to move to the downside, I have position size worst case scenario for half a normal position, half normal risk. And then again, we can cut that in half too, because we usually take our 50% losses if it does pull back. So if we end up risking half of this 550, so $275 to try to make $2,000, that's a pretty good reward to risk ratio if it does indeed bounce. And if it doesn't bounce, it's a really small risk to be taking on a basically a buy the dip signal that may have an earnings enhancement, provide the fuel to make the run up towards the upper end of these levels and maintain that strong long-term trend that we're on. So that does it for today. As always, you've heard from me now. Now I want to hear from you. So let's keep this conversation going in our Market Outlook forums. There's a link popping out right there on the top right corner of your screen. It takes you directly there. Remember, you have to be a subscribed member of our site to participate in that forums, but I showed you earlier how you can do that for free. Open up any new thread with any questions or comments about what we talked about today, or about something we didn't talk about that you want my take on that pertains to this topic. Let's keep this conversation going. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video. Follow me on Twitter for more content in between the videos, and join our Market Outlook community that we've created on Facebook. Again, have a great rest of your Monday night, everybody, and we'll see you all next time.